welcome everyone. Joe Mass here again, your Chief Investment Officer, and let's get you caught up on what's going on in the market. So, what we're going to cover today, we're staying in theme. You've seen this before. We're going to talk about what happened last quarter, quick review. We're going to talk about inflation, interest rates, corporate earnings, the Fed's actions. The 10-year bond is still in the news, the VIX, right, the volatility, and then some market observations. So let's review. All right, the past, stocks, bonds, commodities, and technology. Well, the first thing I want to point out here is the commodities, and that's your top red line. And, we've seen commodities continually increase over the last 6 months, and especially the last quarter. And that makes sense, right? Because we've seen inflation increasing. And if you think about it, where does inflation come from? Inflation comes from the increase in prices. Well, what are prices? Those are commodities, right? That's coffee and oil and inputs. So by definition, if commodities are on the rise, then there's a strong correlation that inflation is going to follow. So the red line is showing you that commodities as an asset class has done very well, and it's no surprise because we have seen inflation pick up. Now we've been doing a lot of writing on inflation, so hopefully you've been reading our snippets that we send out, but inflation has been increasing. Okay, the next line I want to look at is bonds. That's the bottom blue line. And bonds have been pretty flat for the year. We're going to talk about the rise and fall of the 10-year bond in a few minutes, and we'll elaborate on that throughout the talk today. But again, the bonds, they've been pretty flat. But what's more interesting is let's look at the S&P 500. That's the green line. That's stocks. And let's compare that to the technology line, the technology sector, which is the purple line. And you'll notice that early on in January that the S&P and the tech stocks were tracking pretty well. And then about February 16th, we saw the technology really start to slide and leg behind the S&P 500. And if you remember, that leg started when we saw that unexpected and sharp rise in the 10-year bond, which had the fears of inflation embedded in that. Right? And so that's where the FANG stocks and the growth stocks and the tech stocks started to take a little breather, and we continued to see the sector rotation or the secular rotation from value to growth, and we saw from large going out of favor and small cap companies coming into favor, right? So that's what's happening there. And then you'll notice that in the end of May, that purple line really started taking off again, and that's when, as we'll see, the 10-year bond started going back down. We started rotation again back from value now back to growth, and from small back to large, and we're going to explore that further today. But this chart is a really nice way to view what's been going on with this rotation and how these broad asset classes have been affecting portfolios. Okay, the past. So in the past, the broader exposure, what we call beta, or the market, has been prevailing over focused investing. So we're predominantly a focused manager, and so we've been lagging a little bit because we've been holding on to some of those stocks that have been caught up or adversely affected by the rise in the 10-year and in this rotation. And so last year, there was just a few people that were winning, and we were lucky to have picked those stocks. And this year we're still sticking with them, but as more companies have been participating on the recovery because of the COVID story, right? Because of the vaccines, because of the opening of the reopening of the economy, more stocks have been coming to the party. Okay. Well, we didn't abandon our growth stocks. We didn't get rid of our Microsofts and our Apples and our Googles. We stuck with them because they're world-class companies. Even with the fear of inflation, we still feel that our portfolio companies are going to have a really good opportunity to survive in that inflationary environment. So we have underperformed a little bit because of that broad exposure, that beta effect, and we are focused investors, but we're going to be patient, we're going to stick to our processes, and we're very happy with how everything's positioned. Again, we talked about rotation, right, from value is coming back to growth, but it has been more of a value show. And that started about last August, and we've been talking about that, and that's again why we've we have a value portfolio, focused value, and we have dividends that are coming back in that space. Size In the beginning of the years, the smaller cap and mid cap companies have been working over the large companies. Our portfolios are typically right now positioned with larger companies. So again, another reason that we've lagged a little bit, but as you're going to see, those larger companies now are coming back in favor, and those small companies are rotating out of favor. And it's been kind of a tug and war in the market, and we've been seeing this going on for the last year or so. And so the last bullet point here, or the second to the last bullet point, the leaders to laggers and back to leaders is what we're experiencing. So we just have to be patient. We're going to maintain our process. We like our process. We recalibrate the portfolios, but we're not going to change the process. We're just going to manage through this rotation. Okay, what drives the market? This hopefully is becoming familiar to you. Inflation, interest rates, corporate earnings, the Fed, and of course, geopolitical shocks such as COVID. Those are hard to predict, of course, but the inflation, interest rates, corporate earnings, and the Fed are something that we can form opinions about, and we can incorporate that into our portfolio management processes. So here we go, inflation. As you've been looking at this slide with me for the last year, you've noticed that at one time the inflation measured by the PCE, which is the orange line, was as low as 1.2, and today it's at 3.9. We've been talking about in prior videos, why not inflation? And there it is. It is at 3.9. The University of Michigan's 5-year inflation outlook is still at 2.9, so it's a little bit higher than the Fed's mandate on the red line at 2%. And really the big question here is this inflation here to stay, or is it transient? And of course the Fed says it's temporary, it's short term, and we'll have to wait and see. I take more of the view of a moderate. I think that some of the inflation is here to stay, and I think some of it will be a transient, and that's mainly due to the constraints on the supply chain. You just can't buy products and goods right now. I tried to buy my wife a bike, I couldn't get one. I tried to buy a car, I couldn't get one. So a lot of the consumer products that we're looking for just aren't available. And of course, when there's supply and demand imbalances, that can cause that inflation. So I think there's going to be some temporary inflation, and I believe that there's going to be some permanent inflation. We'll just have to wait and see how this all shakes out. On the bottom chart here, we see the unemployment rate, the blue line. Again, you see that it's really leveling off, and it hasn't continued its downward slope, and that's mainly because of the stimulus checks and the federal stimulus that everyone's getting, and big debate out there whether people are wanting to go back to work or not. But we'll let other people debate that. Here we're just looking at the data, and the data is that unemployment rate is really leveled off at that 5.9% range. Okay, let's take a look at the yield curve. Here's the U.S. Treasury curve, and of course we want a positively sloping curve, which we have, and that is important because that leads us to believe that there's not a recession on the way, okay, that the economy is healthy and strong. Now you're going to notice down at the bottom, the 10-year rate is highlighted at 1.25. And as you've watched these videos in the past, we've seen that get up to, I think we'll see it on the next chart, close to 1.75, and we've seen that quite low. It's been bouncing around. That's been a cause for a lot of the concerns with inflation and the pullback on those large growth tech companies, but currently it's at 1.25. So here's a chart of that 10-year, and you'll see back on, I think it's May 12th here, the high was 1.7, the low has been 1.19 back on 7/19. And you can see that when the 10-year started to come back down, that's when those growth stocks started to rotate again. That's when tech started to come back in favor. So there is a correlation there between the rotation of stocks, large and small, and value and growth, and what the 10-year bond is doing. So right now it's back quite low, and we'll just have to wait and see where that's going to end up. The Fed is talking about reducing or stopping their bond purchases, which would probably put some upward pressure on yields. But again, we'll keep you posted as that data comes in. Okay, the last thing I'm going to do talking about the Fed here is just the Fed dot plot. You've seen this before. These are the votes of confidence from the Fed governors, and you can see that the green line represents the medium estimate or where their voting rates will be. And again, you can see that they're quite low until 2023, and even in that long-term estimate, it's only 2.5%, so historically low. There's a lot of debate right now whether the Fed needs to take more action faster or not. We'll just have to wait and see. But all in all, rates are relatively low, and the Fed is in an accommodative position, which is good for equities, which is good for risk-on assets, such as stocks. Okay, on this slide, we're going to start talking about earnings. The green line is the current earnings on the S&P 500, which is about $155 a share. The best estimate 12 months from now is at $194, and so that equals about a 25% increase in earnings over the next year. So that's a positive indication. I think that data we're seeing is probably going to be leveling out in the 10 to 15% range, which is lower than 25, lower than the estimates that we've been seeing over the last few months. However, it's still above long-term mean, the long-term trend, and so again, that's positive for risk-on assets. What does all that mean? Well, it means that based on where we're at today and where the estimates are for 12 months from now, that the S&P 500 should be up about just a little lower than 9%. So there is some room in the market, even though a lot of the valuation metrics seem to be high, there is still growth that's driving those returns. Now, when it comes to volatility, volatility measured by the VIX index is at 18, so it's come down. It's relatively low. It's getting into a very nice range. However, you do see these spikes, and those spikes are based on the geopolitical news event cycle when COVID comes out or a vaccine comes out or some news agency has something that puts a little scare in the markets, and we see the VIX spike. And then what's been happening recently, is on Monday the market will fall, and then on Tuesday the market will spike back up. So there's been a lot of these peaks and valleys, but on average the volatility has been maintained. Okay, let's talk about some market observations. We like to look at growth versus value, large companies versus small, market weight versus equal weight, sectors and valuations. And these are a lot of the things that we're paying attention to as we build and manage your money and we maintain our portfolios. So the first one up on the left, the chart on the left here, talks about growth versus value. And what you'll see right here, hopefully you can see my mouse, is that we see this big rotation down, which means growth is out of favor and value is in favor, right? And that started last year. We started talking about that in August. It started happening here. It leveled off. And then we saw this big rotation to value as we saw the economy come back and that broad participation in the beta stocks, the broad participation in the market. Then what we're starting to see now is that growth is starting to tick back up, and that's correlating to that drop in the 10-year bond that we talked about earlier. On the right-hand side, we're talking about large cap companies versus small cap companies. And again, as you've seen in 2019 and 2020, it was really a large cap growth show, right? And then the small cap, mid cap started to come back as the economy started to open and the vaccines were disseminated. And then now we're seeing that the small and mid companies are starting to cool off a little bit. And those large cap companies, again, are starting to come back. Again, these are some of the points that we talked about earlier on. Okay, when it comes to equal weight versus market weight, the reason that this data is important is that, as you'll see here, the market, the S&P 500 year to date, has been an equal weighted index, or an equal weighted index has outperformed the market cap index. So the market cap index is where we have the effect of the Googles and the Amazons and the Microsofts, right? Those large companies that are at the very top of the index. And because they're very large companies, now trillion-dollar companies, they affect the metrics more. What an equal weight index does is it treats all companies equally. It just takes them and divides them all by 500, and everyone gets an equal share per se, okay? And so that equal weight shows broader participation. The market cap, if market cap was prevailing, it would show more of a focused stock party, because again, those top stocks in the S&P 500 would be prevailing. So we saw, right, from our earlier discussion today, we've seen that cool off. We're starting to see that come back. And you can see that if we look over the last 1 week or the 4 weeks, that the market cap, again, is starting to come back, and even over the last 12 weeks. So that is evidence, again, of this rotation from a few stocks driving the market to a lot of stocks participating, back to more of a concentration, and that's the cycle. So this is why we look at these types of data. So what's also interesting on this slide is you can look at the broad sectors on the left, from the materials to energy, financials, technology, etc., and you can see which sector is doing better from a market weight or an equal weight basis. And so it's kind of fun to look at this and see that right now it's financials, technology are the only two sectors that are really prevailing at a market cap weighting, versus everything else is really an equal weighted index is prevailing, which is, again, indication or evidence of that broad participation. But as we come back, and we've talked about those large cap technology stocks, those are prevailing because of that market cap weighting mechanism. Okay, I know it's a little geeky, but this is the stuff that I look at to know how to reposition the portfolio. So hopefully you're finding it interesting. Okay, the next thing I want to show you is the fundamental rank. So what we do is we look at fundamental factors on top of our technical factors to try to determine what sectors might be prevailing in the future. It's always easy to find what worked in the past, but really what our job is to do as analysts is trying to figure out where that puck is going to be going, as Gretzky used to say, and figure out what sectors might be prevailing in the future. So right now we have energy, financials, and materials. Telecom are some of the top sectors based on evaluation. And if you think about materials, they're one of those cyclical sectors that have really come back down, are getting cheap again, and we'll show you more evidence of that on the next slide. Now, energy has been a very interesting sector. It's done very, very well for the year, and it's still expected to do very well. It's still our top ranked sector. In fact, it's so strong that we've started a whole private fund just for the energy sector. Now, energy's also been one of our reasons that our portfolios have underperformed the general market, because we don't have a very much weight, if any, to that energy sector in our broad portfolios. That's why we have a special energy sector. So because of that sector underweight, we're lagging a little bit because of that, and we might be increasing that in the portfolios. But again, we like energy so much that we have created a private fund for that, and we'd be happy to share more about that with you. Okay, on this slide, what we're going to see is the valuation of cyclicals versus growth and other metrics. So on the top left chart, this is valuation of cyclicals versus the growth sector. And the blue line, when it's down, is that cyclicals are now cheaper than they were. So again, remember those cyclicals, the broad participation, the recovery stocks, the get back to work stocks, those were doing very well, but we're seeing those starting to lose steam. And this is evidence of what we've been talking about throughout the day. When on the top right, when we look at cyclicals versus the industrial proxies, again, cyclicals are now cheap. When we look at the S&P 500 composite versus the cyclicals, they've rotated, okay? And the same with growth proxy. So these are just the data that we look at to know how we might want to reposition your portfolios. On this slide, what we're looking at are some of your more common metrics of valuation. Everyone is familiar with the price to earnings ratio, but these are some of the other valuation metrics that we look at. And so if you want to look at the last column on the left chart, the S&P 500's PE is 23.5, and you can see energy's at 18, materials are at 17.5, financials at 14, and you can read down the list. So these are how we can kind of look at the sectors and which sectors might be relatively undervalued and relatively overvalued compared to the broader market itself. On the chart on the right, I'm going to skip this. It's a little geeky. This is just putting it into a relative 10-year average perspective. And so I'll just show you one as an example. If you look at materials under the PEG ratio column, you'll notice that materials are at 0.7%, which just means they're very cheap right now. And again, since that's in the cyclical bucket, that's making sense. The whole story's making sense. Okay, well, what are we going to do with all this? What's the outlook? Well, U.S. equities, we're still bullish on equities, even though we know there's going to be corrections. We know there's going to be ups and downs. We don't see any evidence yet to see a sustained bear market. Some of our technical indicators are negative. We've been holding some cash. We've been managing through that. But in general, we're still bullish on the equities. And again, we saw, just shy of a 9% return over the next 12 months. That's a great return. It's larger than a historical average of 7%. So we're still bullish on equities. International equities, again, we're bullish on. We're still favoring U.S. equities over international because of the home country bias, but we like equities, and therefore we like international equities. The emerging market equities, we're neutral. Again, emerging market companies can get hurt if the dollar gets strong and if rates rise. So if rates start to rise again, that means there's better opportunities for people around the world to put their money in the U.S., which takes away from those emerging markets. So higher rates and a strong dollar will not be very favorable for most emerging market equity companies. Fixed income, again, we're neutral. Really, we're waiting for the rates to rise, which would start the secular bear market. They kind of go up and they come back down. They go up, they come back down. They really haven't had a sustained trend of increasing. But we are at the bottom of a cycle there, so we're not bullish on that. We're not bearish yet. We're just neutral. We do need to maintain some fixed income in the portfolios to protect them because it is a risk-off asset, and we will maintain a overweight to the risk-on assets, which would be equity. For U.S. real estate, we're neutral. It's been doing very well as an asset class this year. Again, the inflation of lumber has caused the development cost to go up and to rise. There's a lot of noise around real estate right now, but we do think we'd like to be bullish on the real estate. We're not bearish on it, but again, that's why we're neutral. We're not bearish. We'd like to be bullish, but we're not quite there yet. We do like our real estate portfolio. It has been more of a beta show this year. And so, again, more broad participation. When I say beta, that just means that the market is doing well as compared to the active management within that sector. So there you go. We are neutral on the real estate. So going forward, we expect longer term rates. Taxes are still out there. We're not sure what's going to happen with taxes, so we'll just stay tuned. Inflation, we've already talked about that. We're not sure if it's going to be here for long term or short term, so we're going to maintain our vigilance on that. The interest rates, we would expect them to start going up, especially if the bond purchases slow or the Fed stops or slows their purchases of their bonds. Increased opportunity for active and tactical management in asset allocation and in stock selection, but patience is going to be important. This is a year of an inflection year. This year is something we talked about early on in January, that this year is going to be a year where we're just trying to figure out where everything's going to go, right? We've seen leaders turn to laggers, and then laggers to leaders, value then growth, and then growth back to value. We saw small to large, and then large to small. We're seeing a lot of these tug of wars going on, and so we're just waiting to see if we can find some winners that are gonna maintain a trend and some strength. Okay, so we're paying attention to that. Risk management, tax avoidance, again, may be popular, and we're watching that. Corporate earnings are going to be, lower than they have been. Again, we can't sustain 25 and 30% growth rates. We do think they're going to be maybe 10 to 15% over the next 3 to 5 years. So not as high as they've been in the recent past, but much higher than the long-term trend on earnings growth. So with that, we're watching the revenue, we're watching the margins. We'll continue to look at all the fundamentals, and we'll put the puzzle together for you. So we thank you so much for listening and watching today. And if you have any questions, of course, give us a call. Thank you so much.